Hi, my name is Ishmael and today we're going to be talking about mortgages, in particular home buyer mortgages. Now, you might ask, why am I talking about home buyer mortgages when this is a property investor channel or property channel? Because home buyer mortgages over here are obviously going to be influencing what's happening over here in the buy-to-let market, because the mortgage industry is always balancing mortgages out, risk and reward. Banks have to balance their risk sheets. They have high risk, medium risk and low risk, and they always have to balance these out. So with buy-to-let and home buyer mortgages, they're going to be reflecting what's going to be happening in the other market. So the mortgages I'm talking about in particular are the new mortgages that have come on the market in the last week or so, that I've heard about anyway. And these mortgages are 40-year fixed rate mortgages, or lifetime mortgages as they're commonly known. Now, these mortgages have been out in Europe for quite a while. In fact, I know that in Germany, as long as I can remember, which is probably around about 10-15 years, they have had fixed rate mortgages for at least 25-30 years as a minimum, which is the term of the mortgage. So they're only just brought them out in England. Now, why are fixed rate mortgages really important, or how do they affect the British market? Well, I see them affecting the British market by the mortgage companies saying, we know interest rates are not going to go above X. And we know that this is going to happen for the next 40 years. So, they've decided that for the next 40 years, interest rates are not going to go up high enough for them to say that this mortgage rate is losing them money or not making them as much money as any other product on the market. Now, it's good for home buyers because it gives them security, and it's good for mortgage companies because it gives them security, because you're not going to be switching products because you're fixed in. Now, if you do decide to switch products, you are going to be paying penalties, which is how they know that it's a good product for them. So, with regards to the interest rates on these mortgages, well, they look like anywhere between 2.8% and 5.4%, depending on the company, depending on your circumstances, and depending, I assume, on the loan to value. Now, the lower end is obviously going to be the better loan to value, and the higher end is going to be the worst loan to value, so you're looking at 90% mortgages, and those are at the 5% mark. Now, what does that mean? It means that they expect the Bank of England rate not to go up beyond a certain point where they believe that they are still going to be making a profit on top of that. So, I reckon that they are talking about 2.5% to 3%. Bank of England rate will never go that high, but they want to make 2.5% to 3% on their mortgage product, which means they do not expect the Bank of England rate to go above 2% in the next 40 years. That means that we can quite confidently say that interest rates are going to stay low. How low? I'm not 100% sure, but I'm very sure, based on these mortgages, that interest rates are going to stay low. If I had to guess, I would say Bank of England rate was going to stay below 1% for the next 5 years as a minimum, possibly 10 years before it goes to 1% or above. And that means that we know that borrowing money is going to stay cheap. So if you like this video, subscribe to my channel, whack the bell notification icon to get notified of videos coming out each and every week.